Welcome to the Investing Based on Fundamentals Guide to Fundamental Analysis. I'm Nimish Pathak.
I'm Ankur Pathak.
So we're going to go through the most important, very interesting analysis now. The last part is this very popular, used by Warren Buffett and many other uh, popular valuation experts like Aswath Damodaran and those guys, right? So that is discounted cash flow analysis. So what is the goal of discounted cash flow analysis? This is to find out what exactly is the intrinsic value of the company. What is that real value? We are still trying to figure out, right? So this is done using a cash flow analysis, using cash flows, right? So our purpose is to find the intrinsic value of that asset of the company using the present value of expected future cash flows. So let's look at this example. So let's say this is a restaurant business, and these are all future years. So right now is 2023. So these are future years. So what the restaurant owner is saying is, I'm going to have $1 million cash flow in 2024, 1.2 in 2025, and so on. And the last year, he's forecasting $3 million. That's what he's going to have a cash flow in that year. So the prospective buyer basically asked him, what is your projected sales or what is your projected cash flow? So he gives this Excel. And then the discount rate. So what is the discount rate? So if there's no risk, if you're investing in a risk-free equity, that could be, say, treasury bonds, right? There's no risk, it's guaranteed. That risk-free could be, say, 4%, 5%, whatever the number is. The discount rate is nothing but let's add some risk. And what is that maximum return you can get? I'm willing to take the risk. So that EPR, it's called equity or ERP, equity ratio of premium, basically risk factor. We added the risk factor and say, okay, this is the possible return ROI each year on this much cash flows. So this is over several years. So now I have to revert back to today's value. What are the values of this cash flows? Today's price. And there's another thing. The company is not going to last for 5 years, but this guy is a projection for 5 years. The company may last for 20 years. So he has one lump sum number that $5 million, let's calculate, let's assume that this $5 million is for the remaining years, the life of the company. So that's called terminal value. That terminal value there are two formulas. There's a specific mathematical formula. It's not complicated. But the simplest formula is in the fifth year, whatever is the EBITDA value, earnings before interest, tax, depreciation, and amortization, multiplied by 5. And that comes out 5 million. So we are assuming that, okay, 5 million is for the future cash flows after 2028. Now I have to convert all these values into present value, today's value, right? So let's calculate the present value. So I'll give an example. I did calculation here, and I'll give some examples. So next year, if I'm going to have a cash flow of 1 million, that is today is $909,000, right? If I do the present value of 1.2 million, it will be today's dollar will be 991. So that way I'm converting all this into present value, including the terminal value. See, the terminal value, 5 million after 5 years will be today's 3.1 million. And then I'm adding up all these values. It comes out $9.3 million. So DCF analysis is saying, if the owner is selling me this business, based on this data, as a new prospective buyer, I have this number in my mind. This company is worth $9.3 million, right? Now this company has stock as a share out in the stock market. And the value of that stock is say $15. And it's got $1 million, 1 million outstanding shares. That means shares in the market owning by all the retail and institutions. It comes out $15 million. So the stock market is saying the valuation is $15 million, whereas my intrinsic analysis using DCF is saying $9.3 million. So as a prospective buyer, I feel that the stock price is overvalued, and I'll negotiate with the company and say, hey, you got to come down. Okay, it may not be 9.3, but I can give you 10 million or 11 million, right? But I am also judging, since I have the intrinsic value, I now know exactly that the stock price is overvalued. Investors think that it's going to make more than 5 million in future, more than even this cash flow, right? So this is how you got to know. This DCF is very common. Warren Buffett exactly does this. This is what he does. Of course, it's not as simple as this, but just saying the concept is same. So there's a very popular guy, Aswath Damodaran, is a valuation guru. He uses this. The challenge is, how did you come up with this 10%? That's always a challenge. They add the risk factor and all that, right? So that's DCF. So again, this is all under that financial statements and analysis for the fund. There's only one done. Now there are 4 remaining. Then they will go very fast. No worries.
A quick question, Nimish, if you don't mind.
Yes.
Last slide. So the future cash flow that you have,
Mhm.
how do you get the future cash flow? Like, I don't think company publishes those future cash flow, do they?
No, they don't. But just say you're buying a restaurant and you are asking the owner, what was your past 5 years of sales or cash flow? And then what are your projections for next 5 years? Right. So the guy will, of course, he'll try to inflate the number, saying, oh, my business is going to do very well next year and following year. Right. So if you watch Shark Tank, they're talking about past achievements and then projecting the future. So these are estimates. They look at based on how I had 2 restaurants in a city, I'm going to expand 2 more. So my cash flow will increase in next 3 years to 1.5. It's a projection.
If I may, Nimish bhai, Jitin here.
Yeah.
So to address this, basically it's free cash flows to the firm or to the equity. And there is a model that calculates this. And generally what they do is they start from the revenues. They will build out the revenues for the next 2-3 years based on the previous growth rates. Similarly, they will also project all the costs under the revenue item in the income statement, right? And
Yeah.
all of these projections will then lead to an eventual cash flow statement. So they'll project the income statement, they'll project the balance sheet and the cash flow statement. These are the 3 statements involved. And then they will arrive at cash flow from operations, what Nimish Bhai was just telling in the previous slides. That
Yeah.
cash flow from operations is then accounted for whatever capex the company is trying to do in the next years, and all of those projections are done by analysts on the Wall Street based on the quarterly calls, that earning calls that we hear, or they don't only discuss results, they also discuss future plans for the business, etc. And based on that, the different analysts then come up with different projections and assumptions, and then they will have a different DCF valuation. However, the method, the discount cash rate, etc., is almost the same for everyone, because as Nimish Bhai mentioned, there is a formula to calculate the discount rate, and that formula uses market numbers, market projection, and similarly for the terminal year, there is a terminal growth rate, which essentially should be the industry's average growth rate. But again, every analyst tries to explain that in their equity report, the research report that they publish and sell to institutions. So that's the idea. This is just my 2 cents. Sorry. Continue.
No, this is good information. So Jitin is also a very experienced financial guy. So appreciate your input. Someday I'm thinking we should do a separate session just on discounted cash flow. It's very popular. So, all right, cool. So that's that. So now we are going to the second step. So first one, we did financial statements and ratios and DCF. Now we are going to look at the industry analysis. So this is now you are still evaluating a company. You want to buy it or not, right? That's what you are trying to do. So now you are going at the industry level. So so for example, communication industry with Apple, right? Or commerce industry with Amazon. So now you're looking at the commerce industry or communication industry. So what do you look for? So you basically look at the characteristics of an industry, right? Example is EV industry, cybersecurity. Completely the way these three industries work is very, very different. They're very different from each other, right? So they have their own characteristics. Then is it growing, right? Some industries are very stale. They go at a very slow pace. An example is artificial intelligence industry is ramping up. There's a lot of hype, speculation, right? So are you investing in a dull company, value company, or a growth company like AI companies, right? Nature of competition, right? There's intense competition in logistics industry. So you need to think 10,000 times before you invest in one specific company in logistics area, right? Nature of products, right? Iron and steel versus pizza and banking, totally different. All three are, they work differently. Life cycle of an industry, right? Farming products are based on seasons. Skiing industry, are you investing in the skiing industry in you know April, May, right? um Profit potential, tech industries are doing pretty good, right, compared to departmental stores, brick and mortar. Profit margins are much higher in technology. Import and export policies, right? This is defense factor. They go through very strict import-export policies, right? So are you investing in a company that may or may not be able to sell defense supplies to other country because the policies change, right? The Ukraine war could change these policies, right? Or some conflict in Mid-East could increase the Northrop Grumman and Lockheed Martin's sales. That could happen. So we need to understand the industry level trend, how the industry is heading, where you are investing. Next one is the management and leadership. This is very important. You need to evaluate, research the management and look at the leadership, and look at their track record. Strategic vision, very important. They need to be pretty good in finance analysis and all that, financial decision making. Talent, they need to be really good in getting right guys on board, right? And if you have seen a CFO leaves a company, the stock drops. That's strictly because loss of a talent. Our CEO moves on to another company, stock will drop. If Chipotle guy loses a CEO, stock will be hurt. Maybe temporarily. Risk, how do they take the risk? Communication, very important. Transparency, right? Remember that guy, Nikola CEO, a liar, Milton. He was lying so much, and then he got caught. He was not transparent, and the stock went down right after that. Communication is very important. Some examples, successful leaders. Chipotle, OpenAI, James Dimon, JP Morgan is pretty good. Number one bank. Michael Dell, Jensen Hung, he's the one who started with a partner, NVIDIA. Jesse is a AWS guy, Musk we know. Sundar Pichai is doing excellent because he's going through some AI headaches. And Tim Cook, he's been there at the company for many, many years at several leadership positions under Steve Jobs. So he's got experience and he's doing pretty good. All right, the next one is the profit outlook. How are these, what is the future forecast, or how is it looking, growth potential? Right. So the best way to do it is to analyze the growth margins. Right. So you look at Microsoft. The trend is pretty good and it has a future potential of growth. Right. So the look at the revenues, earnings, margins, gross margin, operating, net profit margin. Right. So you need to look at this and you to see what is the past trend. Is it pretty good? Is there a potential? Then analyze the industry trend. How is the overall industry doing, right? AI is doing good. Cloud is slowing down. You could see cloud is, are you going to invest in cloud? Right. So that industrial level trending is EV is coming up. AI is coming up, right? And then the competition. You have Starbucks, Dunkin' Donuts, or here I have example of Amazon versus Walmart versus Alibaba. So they do a CPM matrix, competitive profile matrix. This is mostly this data comes from market research companies. So we have confusion to invest 1 out of 3. Which one would you do? So they do this type of analysis and come up with a score that will help you contribute towards decision making, but there are so many other factors. All right. The fifth section in fundamental analysis, macroeconomics. We know we are already going through that. GDP growth. So if GDP was pretty high and consumer confidence was high, we would be buying iPhones and games and taking vacations and buying toys, and that kind of stuff would be happening. Right. So the macro is deciding and the sales revenue of a company, and so the profitability goes up. People are eating out and Chipotle is doing pretty good and vacations are happening. Expedia stock is going up. Inflation, high inflation caused an issue in 2022. Small growth companies were hurt. They ended up paying so much interest that profitability went down. That's why all those investors ran away. So many growth companies lost up to 70, 80, 90% stock price within like 6 months because of inflation. Trade data, right? Export import data. So these guys, they release this data on a quarterly basis or yearly basis. And if the data doesn't look nice, then the industry may suffer. So for example, oil industry, oil we are exporting. After Russia conflict, the 6% oil coming for Russia stopped because of sanctions. So we were hurt. Semiconductor chips because of Corona, defense, grain, food, grains coming from Ukraine were hurt. Right. So the trade data will say that we did less imports or less exports. And that will that will impact the revenues of the company. Right. So in summary, fundamental analysis, financial statement, we analyze this section, financial statements with the ratios, balance sheet statements, industry analysis, leadership and management, company profit outlook, macroeconomic analysis. And how reliable is, once you do all these things, how reliable is it? It's not always accurate because there's a lot of estimation and assumptions and stuff like, Ukraine war, pandemic, sanctions. Those are completely different factors, external factors that can mess up a company. Even a good company like Apple went through a mess during pandemic, right? So those external factors we don't have control over. And sometimes, short-term trading needs technical analysis, not fundamental analysis. If you want to sell within a week, you're not going to do fundamental analysis. You're simply looking at the charts and deciding. Right? Intrinsic value analysis, so we did DCF, PE ratio, PS ratio, all those ratios. They help us to decide if the stock is overvalued or undervalued. It may need more approach, right? But I'll tell you, fundamental analysis definitely give you excellent insights in the company's financial health. You can clearly see a company is not doing good, but the stock is high. I would not invest there. You will see the health of a company and growth potential. The trend data will tell you they're doing very good, for last 5 years. The numbers are pretty good. And so definitely it adds some faith to the future investment. So it is a useful tool for long-term investors. I would take a informed decision making through this ratio statements, this analysis, than someone just telling me to buy, right? So fundamental analysis is definitely very important. You guys should also discuss at this level in our group or throw a challenge, right? Can we do fundamental analysis of, say, Samsung, or can we do fundamental analysis of, say, Zoom? Okay? And then we need to discuss at that level. because the thinking mind needs to have this type of aspects, those 5 aspects. We need to do the math, run the math and discuss, right? All right. So, but it's not 100% accurate. Best high scoring companies have gone down too. That has happened. All right. Thank you from Nimish.
Thank you from Ankur.
All right.